it's great to have a chance to talk with everybody the day after the election. Hopefully, by the time this is out and in your inboxes, everyone, it's not things haven't changed dramatically. But in terms of just trying to summarize some of the impact that we see following the dramatic election uh, last night. And just to be clear, some of us were up very, very late in the night and then up very early this morning. So we're running on a little bit of a lack of sleep here. Um, it is very positive, we believe, for the markets in the long run, and particularly the equity markets. The breadth of Trump's win, both in terms of popular vote, the Senate being behind him, and the fact that he dragged other people across the finish line as well too, I think is all very important and very supportive in his ability to implement his agenda. And that will have a strong impact on the market. I think, I do want to take this opportunity to talk to two of our advisor board members, Patrick Kennery, who has a long history in the macro universe, and Thano Hasiotis, who has been both an analyst on Wall Street and a portfolio manager in the hedge fund universe, just to talk a little bit more specifics on where they see impacts happening to this. So, Patrick, just give us your lowdown on some of the developments you see.
All right, thanks, John. So I think the first thing, just to put some emphasis on what John was saying, this was a dramatic sweep for Trump. And what that means for thinking about market implications is really that you should expect him to have not a lot of resistance to enacting his program. And his program is basically supply side stimulus for growth in the U.S. economy. There's deregulation, which certainly helps the supply side, tax policy that should benefit the supply side. And then there are some things that are not necessarily positive on the supply side, like immigration and trade, but all of these things are really affecting the supply side of the economy directly. And so you should expect him to be able to accomplish those. And that should be a benefit to higher growth, higher potential growth, and higher actual real growth in the U.S. economy. I think just at the macro level, and I'll let Thano maybe talk a little more specifically about some of the sectors and some of the elements in the equity markets. But overall, like, what does higher real growth mean to asset prices? Is one, you can expect higher real interest rates because interest rates tend to track where real growth is. And what the impact of higher real interest rates is, you should expect a stronger US dollar. That's going to have some impacts on whether global assets look attractive relative to US assets. And then because of the strong growth in the US and the capital flows coming into the dollar, they will tend to flow into US assets. And so it can be positive for US assets across the board, even things that aren't necessarily traded, anything from real estate to equities to anything that's in the US. The US will be an attractive destination for investment. So that's I guess the one final thing is, on the supply side, we would expect supply. So for instance, oil is a very important element for inflation. And you would think an effective and positive supply side policy should cause inflation to, in the long term, be relatively tame. It should be that, ultimately the thing that prevents high inflation is productivity, and we should expect higher productivity. And one of those areas is energy. If drill baby drill, as Trump said, it is effective, we might expect to have lower energy prices.
So Thano, you've been thinking about this and some of the implications a little bit more granularly in the equity markets, because it's not necessarily just going to be positive for everything in the market. This may in fact be a situation where it's more sector specific and more of a stock picker's opportunity. How are you thinking about it?
Yeah, thanks, John. Well, first, let me state that at this moment in time, we are assuming that the Republicans keep control of the House, okay, which speeds the ability of Trump to do the things that we have discussed already. Um, I think it's important to just remind everybody that Trump has discussed, we don't know for sure what he's going to do, but he's discussed reducing corporate tax rates further. So right off the bat, you just get more earnings, which would be reflected in stock prices. We all know that he has talked about extending the individual tax cuts that were set to expire. But on the campaign trail, he mentioned a whole bunch of additional deductions around interest expense on auto loans and boat loans and things like that, all of that, which would be very sort of stimulative. Um, Specific industries that would benefit from deregulation, which I think has the biggest, most immediate impact. And that's why his winning of the popular vote is so important, because it allows him to push through his appointments that will change these regulations by getting them confirmed quickly and speedily in the Senate. Those industries are going to be the banks, oil and gas, as Patrick mentioned. He's very likely to remove Lena Khan at the FTC, which will restore the M&A world. He's likely to remove Gary Gensler, who had a very heavy foot on the SEC. And all of those moves, particularly with the banks, allows them to get back in the business of making loans and making capital available for business formation. They all kind of go into my very real category of animal spirits. And animal spirits are real in the sense that if corporations or corporate boards do not have confidence in the outlook, they tend to reduce their capital spending plans. When they have confidence, they don't want to be left out. They want to take advantage of any increase or acceleration in GDP growth. It becomes a self-fulfilling prophecy. And I think the animal spirits are going to be very high during this administration, particularly coming out of the gate. That means that from a sector performance, you could see, as we saw today, banks do well, certain industrials do well. And I would put technology in there as well, especially since a lot of it is based on GDP growth, which is likely to be higher. There are plenty of other sectors that may not do well. So I think it becomes even more important to have active managers that are selecting stocks based upon let's call it the new landscape that we're looking at going forward. I mean, for example, solar and wind stocks did incredibly bad. It's likely that that he eliminates any further spending in the Inflation Reduction Act, which helped wind and solar. And there's also certain retail stocks that might have a difficult time with select tariffs that he goes to. I just want to add that, some of the negative things that have been discussed around immigration, we'll just have to see what he does with respect to the labor supply. If he ends up controlling the border and deports a few 100,000 people that have criminal records, I don't think the market's going to care about that. I think if he starts going into millions of deportations, then you could get into an issue of a wage issue with construction costs and things like that. But I feel like that's unlikely. He also mentioned something last night where he said that we need to control the border and then we need to change how we let people in. That could be extremely positive if we move more towards an immigration policy similar to New Zealand and Australia, where we have select skill sets that we're looking for that could enhance the productivity, business formation, entrepreneurship in the United States. These people would like to come here and benefit from the best capital markets in the world and a better rule of law. So you can dream up a very, very positive scenario for a broad swath of stocks, with the exception of certain stocks in key industries that I think our active managers are certainly capable of, navigating the landscape.
Well, thank you. I will say, I think the one sort of constraint that we're going to have, and I think that that's one of the things what we do kind of feel with the election is those things that we're going to constrain politically, what Trump could do, have gone to a little bit into the background, quite simply because of the nature of the vote, the popular vote, and the strength of the mandate that he did receive. That being said, I just want to remind everybody the bond market and the yield curve can always constrain what activity you do. And I always remember Bill Clinton saying he wanted to come back as a bond vigilante because they seem to have the real power. And so it was something we just have to keep an eye out for as well too.
John, I think that was Carville that said he wanted to come back as a bond vigilante.
Okay.
I remember those words well when I was on the sell side, and I remember trying to come up with valuations for transportation stocks and having to, judge it against the 10-year at that time. I think that will be an interesting test to see if the bond market feels that the GDP growth acceleration will offset any sort of immediate deficit expansion from tax cuts. And the bond market, usually approaches this with a steady hand. So we'll see. But if the bond market gets upset, that's a risk to our bullish outlook.
Most definitely. Well, we're just going to be brief today, but we did want to make sure we had an opportunity to speak to you all and give you our sense of what some of the implications are. As always, we're glad to take any of your questions. Just reach out directly, and we will entertain all of your questions and all of your concerns. Thank you very much.